All right, well, driving the market action in the NASDAQ today, that disappointment from Meta. Shares are off just about 15% here in the pre-market action after the tech giant's big spending plan spooked investors. Well, Meta will likely wipe out $200 billion of its market cap at the opening bell. For a deeper dive into the company's results, we want to bring in Brad Erickson, RBC Capital Markets Internet Analyst. Brad, it's great to have you here. So when you take a look at the reaction that we're seeing in shares off just about 15% here in the pre-market, does that make sense to you given the report that we read last night?
Yeah, probably an overreaction, to be upfront about it, but nice to see you guys. Thanks for having me, by the way. I think from a revenue standpoint, things were generally fine. They beat sell-side consensus actually for Q1 and guided slightly ahead for Q2. I think the investor side, buy side, was probably closer to an inline report. The issue was obviously cost, right? They raised the operating expense guidance modestly, and then the capex was the big one. They raised that 12%, 8% ahead of the street. To us, that's maybe a bit more of an appropriate magnitude.
So coming off of the year of efficiency, of course, it was celebrated given the stock price reaction that we had seen out of the gate in the first quarter of this year. Now you get these results, Brad. What is this year for the company? The year of spending, the year of capex?
Totally fair question. You know, as we were talking to the CFO last night on the callback, I think it's still, obviously maybe not the year of efficiency is the quite right way to say it, but they're still very, very focused on controlling headcount costs. They kind of called out that none of this increase is really owed to anything from that perspective. So I would say from that perspective, year of efficiency is still very much in play. This is a capital expenditure issue where they're having to spend a ton of money to build infrastructure and obviously acquire GPUs to run their AI research and product development in the future.
Brad, what do you see that ultimately the impact that it's going to have, the Gen AI investments here? What is that going to do to engagement here in the longer run? And what do you see it doing, the impact it's going to have on revenue for years to come?
Yeah, for sure. We think it's a kind of the next leg of outperformance type growth relative to the ad market in general. It does a few things, right? One is that it helps them develop, we call these probabilistic models. It basically means that they're figuring out what ads are driving which conversions, and then they're optimizing and making those campaigns perform better and better. Two, you mentioned it, it recommends content, right? Everyone knows about kind of the TikTok killer algorithm. Meta's worked on that a ton with Reels in the last year, and that's going to continue to get a lot better and cause people to spend more time on it. And then third is, we call it kind of, it has the potential to increase users' utility of Meta. And specifically, it's things like using a virtual assistant as kind of a research tool and a discovery tool on the internet. And then also think about businesses connecting with their customers in new ways, not just customer service, but just maintaining a much more open line of communication with their customers. That's adding actual utility. That's revenue growth for these guys. So there's a lot of ways it contributes in the future.
How accurate will those engagements with an AI type of engine or interface need to be in order for businesses to feel comfortable relinquishing that? Because they've talked about how successful conversions have been to drive purchase decisions. And now we're talking about conversions with relation to making sure that you're not losing out on the digital body language or missing out on that and ultimately dampening or hindering a customer relationship.
Yep, totally. Yeah, I think if you talk to most companies or a lot of companies, executives who have begun, certainly the ones that have a customer service or support component of their business, I think a lot of them will tell you there's still very much a human component. They want to deliver the right experience that's on brand, exactly what their kind of mission as a company or product is. I don't think any of that changes. I think with that said, I think Meta's capabilities on this front can fill in and drive a lot of efficiency there. There are still going to be a lot of sort of like trivial black and white things that customers are going to really appreciate a more direct line to the company for, even without missing out on a lot of the value that I just mentioned. Digital body language was the term you used. I like that. I may steal that. I think that's still really important, of course.
Brad, when we talk about what exactly this could mean for some of the other larger players within the group, we're seeing a reaction in shares of Alphabet here this morning, amongst a long list of companies, obviously, that are taking a hit following the results here from Meta. Does this signal anything just in terms of a reality check maybe that we could be getting from Alphabet, from Microsoft after the bell here this afternoon?
Yeah. Just to be clear, I won't comment on Microsoft because I don't cover the stock. But for the other ones, certainly the advertising names. I mean, there's two read-throughs, right? One is just on the digital ads market. I would say the fact that Meta met expectations but didn't exceed, probably could be a little bit of a net negative there. Just that we know Meta is outperforming the digital ad market. With Google, there's data out there, so investors kind of have a sense of what the results are. But I think for everyone else, given that Meta's outperforming, it could lean a little bit negative on that front. And then on the capital expenditure side, right, that hits at the cloud business and the infrastructure build. It's a positive from that perspective. All these companies are spending more. The issue, of course, is Google is both a spender on that category as well as a beneficiary, and so it kind of works both ways. So it kind of is a mixed effect for Google from that perspective.
Brad, just lastly, while we have you, I mean, we're looking at about a $75 pullback on shares of Meta this morning. A lot of investors, as they're charting their strategy for not just today's trading activity, but looking out into the horizon, trying to figure out if this is a dip that they should buy in on. What within this report tells them that there is something that they can kind of hang their hat on if they choose to do so?
Yeah, I think, Mark on the call talked about how they've been through some pretty messy transitions historically, three in particular, mobile, when they shifted to stories as a new service, and then most recently when they expanded into Reels, short form video. And they've always done it really successfully, but it's always started out with a period of investment and pretty volatile downward reactions in the stock. And I think this one's no different. So the question you got to ask is, as you think about, do you want to buy the stock on this pullback or not? Do you believe that AI is going to be this transformational driver for this company? If you think that they can do a lot of the things I was talking about earlier, buy the stock. If you don't, I guess not. We'd be buying it.
Brad Erickson, RBC Capital Markets Internet Analyst. Brad, always a pleasure to grab some time with you. Thanks so much.
Thanks a lot.